Hi, everyone. Good afternoon. Welcome to another session with Jay Pelowski. We have lots to talk about, and lots of great insights. For not only the following week, but also through the year. And it's been an interesting week. Last week where a lot of Jay's calls have materialized and in a big way. We're going to talk about that later. But why don't we start with the title of the musings, which is called Clarity? So I'll let Jay, I welcome him to talk about that and what it means for his tactical trade, and then we'll move on as usual.
Great, Roberto, and thanks. Hello, everybody, and great to be with you on another live session with Home Research. Always a pleasure. So, yeah, Roberto, Clarity was the title of the musings on Friday, and it struck me that in New York lately, it's wintertime, so we've had a lot of fog and mist and rain and a little bit of snow. And it struck me at one point I was looking at the Empire State Building, and you have the very top of the building there, and it was drifting in and out with the fog. You'd look at it and you'd see it, the spire, and then 2 minutes later you'd look at it again and you couldn't see it. And so it was that analogy or that picture I had in my mind in thinking about clarity, as an investor, right? Sometimes you feel like you really see what's coming, and you have a very clear view on a stock or a sector or a country or an asset, and you can go accordingly and invest accordingly. Other times, obviously, things are more opaque and it's a little bit of a challenge. And so this idea of clarity is something that I think we seek, and sometimes it just shows up, right? And other times, I think most of the time, at least for me, it is a result of the process, right, of doing the work that leads you to a sense of clarity, like, okay, I understand how things are lining up, and here's what I'm going to do about it. And so for me, in this case, clarity comes from the work. So last week, as you know, we had our model portfolio update review session, which we do the first week of every month for our two models, our global multi-asset GMA model, and then our TPW20, our 100% thematic model. So we did that. And then late last week on Thursday, actually, I was on Bloomberg, both the radio and TV. So I had a double head on Bloomberg, and obviously had prep notes for that. And so the musings on Friday was actually the triple filter. So it was the third kind of go round, right? First, the thoughts coming out of the client of the portfolio review and the client note, which I write to clients after that review. So that was step one. Step two was the notes for the Bloomberg sessions. And then step three was putting it down in the musings. And I always like it when the stuff just, flows, right? When you just sit down and write and boom, out it comes. You were an analyst, you don't know exactly what I mean. Other times it's like you're really struggling to kind of pull the pieces and make something happen. In this instance, things seem really clear to me, and particularly on the tactical side. So why don't I spend a few minutes talking about my tactical outlook, and then we can move to the strategic and talk about portfolios and things of that nature.
Yeah, that would be great. So how we can follow up that order? Yeah.
Next several months. I expect that we're going to see lower than expected inflation prints. Okay, I think the ECI number that came out of the Q4 data for the U.S. last week was the beginning of this. The number was high, but it was lower than expected. I think used car prices are another big source of price pressure that is going to start to roll over. Early read is that the used car prices peak back around Christmas. We should get more data on that. And then in addition, in keeping in line with the auto sector, I also expect better than expected growth data. Okay, so we're going to have lower than expected inflation data, particularly in the US, also in Europe, better than expected growth data, also in the US and in Europe. And the auto sector is where I think we'll start to see this as well, right? GM in its Q4 results last week said they expect to have production levels running 25 to 30% above 2021 levels as the semiconductor supply chain issue becomes less of an issue. And so I think you have to remember that autos is picking up, housing is very strong, and importantly, Omicron is starting to really fade as an issue. So we have the whole service sector side of the US and European economies that I think is about to blossom. So to me, there's a real interesting divide, whereas many people in the market are worried about the first part of the year, first half of the year. You know, they quote all the studies about the second year of a presidential term, all the studies about midterm. And I really wonder if the easing of Omicron and the move from pandemic to endemic doesn't overwhelm that historical worry about the direction of the markets. And so I expect Q1 is going to be weak in terms of growth. And remember, we talked about it last time, the difference between slowing growth and slow growth, right? Slowing growth, clearly, US, Europe likely to slow versus last year because of all the stimulus. Slow growth, no, not at all. Let's remember that the average US pre-COVID growth rate was 2.3% real in the 5 years up to and including 2019. In 2022, growth is going to be between 3.5% to 4%. In Europe, growth is expected to be higher than in the US for the first time in about 5 years. And in Japan, growth is expected to be the best in over a decade at roughly 3% growth for the Japanese economy. So to me, while the market is worried about yield curve inversion, I think the opposite is going to happen. I think the short end can rally because inflation numbers are going to come in softer than expected. And we've had a massive move in the 2-year rate in the US, right? It's almost double in the space of a couple of months. So plenty of room for some rally there. And then the long end, I think, is going to continue to widen out as growth comes in better than expected. And that growth better than expected, as I just mentioned, is a global issue, which we're seeing with the 10-year German Bund, as you and I have discussed for a long time, now well over zero, and the 10-year JGB threatening levels in the mid-20s that it hasn't hit in 5 years, right? So globally, bond markets are sniffing out growth. And that growth, coupled with the fact that the cap on US Treasuries at the long end, which was generated by the inability to find any other, positive yielding safe asset, right? Yeah. We had 18 trillion in negative yielding debt. Now that's at like 5 trillion. And so that lifting of that cap means that the long end of the US market, I think, can back up and break the 2% level that we've talked about again for some time. So as Omicron fades and you're reading about European restrictions being lifted, you're reading about Australia lifting restrictions, you're reading about Thailand welcoming back tourists. We've already had in January one of the most aggressive pre-Fed drawdowns in the last 50 years, right? The 10% pullback in the S&P was the most aggressive pre-Fed drawdown in 50 years. And at the same time, as I mentioned about the 2-year, the yield curve flattening has been extraordinary. Before the Fed has done a single thing, we've had the most dramatic yield curve flattening on the 5 to 30-year treasuries that we've seen since the 80s. And so I would argue that a lot is in the price, that fears of yield curve inversion are overstated, that fears of sharply higher inflation overstated, fears of growth in a recession. I think the recession call was just completely out of line. I don't understand how you can have Omicron lift and move from pandemic to endemic and what that means for the service sector of the entire global economy and say you're going to have a recession. It just makes absolutely no sense to me.
Yeah, it's those are great points, and something that you mentioned remind me of something we just discussed, before the call, which is, the market talks about, yield curve inversion, and you think it's going to be the opposite. We think there will be yield curve steepening. So is this just what you said about growth accelerating in the Omicron liftoff being inconsistent with the recession, or is there more to it?
Well, I mean, I think we have lots of drivers to growth, right? We have the consumer being extremely robust. We have almost record low unemployment in Europe. By the way, everyone again fixates on the U.S. unemployment rate. Europe just had its lowest unemployment rate in years. It's now down to 7%, the lowest in I think a decade or more. European unemployment rate. So we have a employed populace with money. We have a capex boom, I expect, and we'll get into this a little bit more in the strategic sector. So I don't want to go too far ahead, but my view is that as we've talked about for some time, right? Synchronized global. Well, first of all, Omicron fades from pandemic to endemic. That's point one, and that clarity on COVID allows us to start thinking about a synchronized global expansion, right? Again, a term that I've used for some time in these sessions. And that synchronized global expansion consists of higher than average nominal growth rates and sustained negative real rates. And this is why all during January, I was not, I didn't like the volatility, but I was not worried about like a bear market, things falling apart, because we have negative real rates, and that's highly, highly unlikely. Financial conditions are loose, highly unlikely that we're going to have a bear market crash with real rates being negative. And real rates still are negative. And again, as we talked about, I think last time, one of the big differences between this likely tightening cycle and the last tightening cycle was that in 18, the real are positive, significantly positive, and that's not the case at all today. So I'm of the view that this lower than expected inflation prints, coupled with better than expected growth, yield curve steepening, reaffirms the rotation, right, from growth to value, reaffirms the rotation from U.S. equity leadership to non-U.S. equity leadership. And remember, those are the two questions I think investors really need to answer amongst all this volatility. Have we moved from 13 years of tech-led leadership in the U.S. equity market? And a corollary question is, are we moving from the 13 years of U.S. equity leadership to non-U.S. equity leadership? And I think the answer to both questions is yes. And I can give you some real quick data points from Friday as an example. On Friday, the NASDAQ, with the big meta miss, was down over 4%. The main U.S. value ETF, IUSV, which we have a very large position in our GMA model, was down less than 1%. Year to date, NASDAQ through Friday was down roughly 12%. S&P down 6%. The ACWI ex-US was down less than 3%. So remember, and this goes back well over a year, but in my 2021 Outlook piece, I talked about a golden age for asset allocation. And I think we really are starting to see that golden age for asset allocation, whether it's cross-asset, bonds look horrible, commodities look great, whether it's, within assets, value versus growth, U.S. versus non. It's really a fantastic time to be thinking macro and to be investing kind of multi-asset. And that's really, exciting for me. And let me just finish up by talking about the setup for the non-U.S. market. So I think I've made the point. Yield curve steepening reinforced the rotation from growth to value within the United States. Outside of the United States, I think the setup for non-U.S. equity leadership is almost close to perfect. And that's not easy to say because it hasn't happened in 13 years, right? Straight from the bottom in 2009 up until a couple months ago was U.S. equity performance dominated the global equity space. But here today, we have a very different environment, right? I would argue that the policy mix outside of the U.S. is much better than inside. Think about the US, fiscal drag, significant fiscal drag this year, and Fed tightening. Compare that to Europe, with next gen spending going to be robust this year and next, and the ECB going to be quite slow in tightening, in raising rates. Think about Asia. Japan as a fiscal package close to 4 to 5% of GDP, and is likely to grow, as I mentioned earlier, at among the best rates it's grown in the last decade. And then think of China. PBOC is easy, very important to remember when you read about all the liquidity and Fed tightening and all this stuff. The PBOC is easing. Okay, that's critical. And at the same time, China has every lever to pull on the fiscal side that it wants to. And I just read, for example, European construction activity at the end of last year was increasing at the fastest pace on record. So, amidst all the noise, if you want to see the data points, they're out there to be really quite constructive. And so, to me, I see yield curve steepening driving the rotation within the U.S., and I see a better policy mix outside the U.S. driving the rotation of non-U.S. equity. And the icing on the cake is the dollar, right? And the dollar rolling over, and we have a weak dollar environment. Now, again, counterintuitively, but factually, the last, I think, 6 or 8 Fed tightening cycles coincided with a weak dollar regime. Okay, so it's not intuitive. U.S. hiking rates, you would think, dollar would be strong, but the market thinks forward, moves forward. It's already priced in to some extent, that rate tightening cycle in the U.S. And the difference between the U.S. growth and policy mix in the rest of the world is narrowing, right? As I pointed out, Japan best growth in a decade, Europe growing faster than the U.S. this year. So I think the icing on the cake is going to be a weak dollar, and that supports obviously commodities, and it supports non-U.S. equities. So to me, I think we're really set up, as I said, a near perfect environment for non-U.S. To take the equity leadership baton.
Fantastic. It all makes great sense. Can we move on, to some of the points we discussed before, and that is, what happened last week. Meant one of your transitions took place, which is the markets throughout last years have been driven by central bank provided liquidity, and now it's earnings, and you could not have a better example than the fortunes of Meta, Google, and Amazon too. So maybe it was a little bit magnified, given how sensitive people are. But would you agree with that?
Well, I do think we're clearly moving from liquidity-driven markets to earnings-driven markets, and that's been underway for probably a year or so. If you look globally, right, there were multiple rate hikes by central banks last year, most of them in emerging markets, right? Brazil, as we all know, has had a massive and aggressive rate tightening cycle, and now look to be close to the end of that rate tightening cycle, whereas the Fed is just beginning. And other central banks, the way I look at it, you have the Fed, the PBOC, at opposite ends, as we've already discussed, in the ECB and Bank of Japan kind of in the middle, not doing much. Bank of England, Reserve Bank of New Zealand and Australia, et cetera. There are other central banks of import, but those are the big four, and you've got one tightening, one loosening, and two in the middle. So I do think the liquidity provision that we've got post-COVID is ebbing. And now companies need to generate earnings. And the good news is, as I mentioned, that they're going to be able to do that in a high nominal growth environment. So if pre-2019 or pre-2020, pre-COVID, nominal growth in the US was about 4%, 3% or so in Europe, right? 2% real, 1% or 2% of inflation. we're likely to have nominal growth in the U.S. this year of somewhere close to 6 to 8%, right? And same in Europe. So 3 to 4% growth, 3 to 4% inflation as inflation starts to decline. And that's an environment where, as we've seen with earnings to date in Q4, companies can maintain margins and can generate earnings. Earnings growth in Japan, according to JP Morgan, is up 30% year over year. I mean, it's just amazing to me. Japan can't get any love whatsoever. Yeah. Earnings growth of 30%, and nobody cares. Earnings growth in Europe is running at about 20%, and in the U.S., it's running at, again, close to 30%, 25 to 30% earnings growth. You're not, and I know I've said this before in these sessions, you're not going to get a bear market when you have negative real rates and earnings growth of 30%. You're just not. But what you're going to get in big cap tech, I think, is a derating. So your earnings point is a very valid one because many of the big tech names, in fact, tech in general has had, I think, one of the best beats of any sector so far in Q4 in the US. And yet none of the stocks, none of the big fangs are up for the year. That is the epitome of derating. Yeah. And so that's how I expect to see the year play out. History suggests that we have a January like we just had, one of the 10 worst Januaries since the 1920s in the United States for the S&P. The rest of the year tends to end up with plus or minus S&P 5%, roughly, broadly. Okay, that to me is a perfect environment for non-U.S. leadership to assert itself, right? Because as we know from painful experience, when the S&P is up 15%, nobody cares about the rest of the world. When the S&P is down 15%, everything goes down. No one can fight that trade. Okay, so a plus or minus 5% S&P, which happens as big cap tech derates, doesn't collapse. This is not going to be a repeat of 2000 because these companies are monster money-making machines with great capacity to buy back stock, great capacity to pay dividends. What's going to happen is they're going to be derated. And that gradual derating is what caps the upside of the S&P and serves to drive the rotation to value and to cyclicals and to the rest of the world, which has less technology and is more value and more cyclical by definition. And Japan is a perfect example of that, as is Europe. And I'll just give you one stat that I read over the weekend that I noted and want to make sure I mentioned today. In Europe, flows into European equities over the last decade, this is 10 years, down 100 billion. 100 billion in outflow 100 billion in outflows from European-focused equity funds, okay, over the last decade. Non-European equity fund flows of 1.8 trillion. 1.8 trillion into the non-European equity markets, including the US, versus 100 billion out of Europe. So Europe has been a net, people have disinvested from Europe for a decade. And I just, it's just, some of these numbers are just amazing. It shows how extended we are in this, US tech and US leadership. And now I think we're starting the move outward. And as we've said again before, these are multi-year moves. This is not a month or a quarter. When this move really happens, and I believe we are at the beginning of these moves, they last for years. Now, everything happens faster in the 21st century, but I still think as this move gets going, it's likely to last for a couple of years. And I think that's really critical to keep in mind.
Mm-hmm. No, that makes sense. We totally agree. And there's another point, and it's a big, another big victory lap for you. You kind of touched on this a couple of questions before, but it's and it has also strategic implications. That is the beginning of the bear market for long dated bonds. So you had a bull market that lasted only 40 years, and now I mean it looks like it's finally turning.
Yes, I mean I've been of the view that we're in a bear market for bonds for over a year, and nothing I've seen suggests anything other than that. And so we had a really tough year. I think last year was the worst year for treasuries in 50 years, and I think if I read correctly somewhere for like investment grade debt, January was just take January and make it a full year, it would have been one of the worst years on record for investment grade. So I think that's likely to continue. And as I said, a global expansion allows for rates outside of the US to go up, which is wonderful. I mean, everybody's worried about the effect of higher rates. I think we should welcome higher rates, because the last thing we want to get off the zero. We want to provide central banks with little room to maneuver. We want to provide them with ability to raise and lower rates as they see fit going forward. So this is not a comfortable position. I mean, it is comfortable to some extent for asset owners, financial asset owners, because a lot of the money went into financial assets. But ultimately, we would want to have a cushion of rates being above zero in Europe and in Japan, and above the close to 1% we were in the US last year. So let me tie this into the strategic outlook I'm operating under, because I think it helps explain why rates are potentially likely to suffer from several years of poor performance, government debt instruments, several years. So when I think about the strategic outlook, I'm talking about 2022, 23 through 2025. Okay, let's talk about the next 3 years. And the market is pricing a return to that pre-COVID average that we talked about earlier, about 2.3% growth in the US in the 5 years up to and including 2019. And similarly, very weak growth in Europe and in Japan. I think there's a different analog out there. And my analog, as I've mentioned before, is the second half of the 1990s, which was, in the case of the US, the last time we had a capex boom and a productivity surge, which allowed for higher than average wage gains without big inflationary pressures. All right. And I think we're setting up for something very similar to this, but globally. Right. So if we think of capex, we have huge infrastructure needs all around the world, right? Whether it's physical infrastructure in the US, where Biden goes to Pennsylvania and the bridge falls down right in front of him practically, or if you talk about infrastructure in Europe with Germany, if you think about infrastructure in terms of digitalization in Japan and the need to kind of really get ahead of digitalization. So we have a huge need. We have cash-rich companies. Again, people worried about credit, but yet they don't seem to take on board that companies are completely refinanced and are totally cashed up. There's tons of money in the corporate sector. So total, cash available, low interest rates, decent growth, huge needs to stay competitive as the world changes very rapidly. So companies need to spend money. So capex boom, productivity surge, driven by multiple technologies converging and accelerating as a result of COVID, right? We don't really understand what that means right now, because COVID has been such an all-encompassing issue. As COVID lifts and we get that clarity I spoke of, both in the musings on Friday as well as in prior monthlies, talking about 2022 as a year of clarity. When we get that clarity, I think we're going to be impressed by the productivity potential generated by all these technologies converging and accelerating, right? We've talked about COVID speed. We talked about climate speed. We talked about analytical speed over the last year. I think 2022, 23, 24, we're going to see what this means in terms of productivity. And when you have productivity, all of a sudden the wage gains get kind of taken out of the equation as wage price spiral fears have to diminish. So I'm of the view that we could be set up in the next couple of years in the U.S. For growth, let's say, of 3% as opposed to 2.3, and inflation of 2.5 to 3% as opposed to 1.5 to 2. So again, nominal growth grows from 4% or so to 6%. And I think there's something similar to that could happen in Europe as well. People really underestimate the changes that are taking place in Europe and the infrastructure spending that is going to be driven over the next couple of years. And if Europe and their policymakers are able to update and make changes to the Stability and Growth Pact to allow for the investment spending on the climate and infrastructure side that needs to be done, that sets up Europe in a very, very robust way. So I think that's the strategic outlook that we should be thinking about. And if we have that outlook of, let's say, 6% nominal growth in the United States, we're not going to have 10-year Treasury at 1.5%. It's probably going to be closer to 2.5 to 3%, maybe even slightly more. Not all at once, but over the next several years. And markets are going to be fine with it because it's going to drive and sustain the rotation into value and growth, which, because we've had 15 years of or 13 years of tech leadership, value can move and move and move and be perfectly fine. Now, obviously, that's not to say that there won't be points when it gets overbought, et cetera. But in essence, strategically, there is loads of room for value to gain back performance relative to growth, and tons of room for non-U.S. equities to gain back performance relative to the U.S.
Yeah, and and then it reminds me of another call. I mean, in your 2022 outlook, you talked about the 10-year hitting at a 2% sometime in the first quarter. So it's early February and we're almost there. I mean, I don't know if we touched 194 today. So I mean, I know this is kind of the $1 billion question, and nobody can really predict. But you've just said that it goes in phases. So do you think this first move, let's say from 1.5 to 2 or 2-ish, is already done? And if so, I mean, what would it take, let's say, for it to go to the next level? Let's say 2.5. Just
Well, markets move quickly. I mean, I would say 1.92 or 93 is pretty much close to 2. So yeah, let's say we're around 2%. I think technically there is a pretty big level, slightly north of 2. I'm a big believer in technical analysis in these kind of ahistorical markets. And the folks who I look at for this type of work say that at about 2.05%, there's a pretty big technical level. I think that's actually the very long-term chart level from the 80s that you spoke of, when treasuries, short-term treasuries peaked to like 15%. I think right now that trend line is about 2.05%. So I wouldn't be surprised to see a little backing and forthing at all. But as I said, I mean, I think the issue is that we could have a stronger growth outlook in the next couple of quarters than people are positioned for or expect. And it may be an interplay between that versus inflation clearly rolling over. Because remember, we have in March, April, and May, big numbers from 2021 falling out of the CPI year-over-year calculus. So as I've argued repeatedly for months, the 7% type inflation numbers we saw in December, probably going to see in January here in Thursday, and maybe in February, though I think that, as I said, I think the numbers are going to start to come down. Almost mechanically, they come down in March, April, and May as those big numbers from 2021 fall out. But what I want us to think about, Roberto, is the idea that if the strategic outlook is right, the disruptive tech space, the ARC names, the thematic names, that have been devastated, that have been in a bear market for almost a year, that have halved or more, that were the victims of capitulation selling over the month of January. If the strategic outlook comes to pass, this period right here will be seen as a fantastic buying opportunity in that disruptive tech space. Now, I'm not ready to go out there and say that is going to happen. I am positing that the two things, if they go together, and if we have a period where 2022 is kind of the bridge to a better, higher nominal growth, multi-year period akin to the second half of the 90s in the US and globally, then people will look back and say that this capitulation selling in the archetype names was a fantastic buying opportunity.
Yeah, no, I was going to ask. I mean, other than ARC, are there a few names you would mention to the audience?
Well, I think let me frame it by talking about the potential for a spring rally, and then we can touch a little bit on some of the moves we made in our models last week. So I, as I said earlier, really look at technical analysis in these markets. And for every portfolio review session, and as a reminder, we review our portfolios monthly here at TPW Advisory. And as part of that, I go through every single position in the two models, as well as our watch list of anywhere from 20 to 40 different ETFs, and look at their technical positions. And just to kind of familiarize myself with where everything is, particularly in the markets of the last 4 or 5 weeks, depending on the day or even the hour, it could be 10 or 15% different. But what I noticed were two things. First, that the cyclical and value ETFs bottomed on January 29th, 2021. Literally, they all bottomed on the same day and rallied aggressively about 30% on average into the May period, when Delta came along and smacked everything back, right? Now, this year, I noticed that the same ETFs, the cyclical, XLE, XLF, all these types of names, bottomed on January 27th. And it just struck me, history doesn't repeat itself, but sometimes it rhymes. Maybe we could have another big rally in the spring here, which no one is expecting, right? Everyone's focused on the fact that the first half of midterm election years are tough, blah, blah, blah. I think we should think about the potential for Omicron fading away, for strong earnings growth, for the realization that big cap tech is no longer the place to be. If that can spur another significant rally in cyclical and value stuff here over the next couple of months. And I think virtually no one is ascribing any of that or a possibility of that. I think it's a very real possibility. And so I did some more work, and I came to realize that the 3 best months for value out of the year are January, March, and April. Okay, we're in February. January was awesome, as we saw. We're in February, maybe some wishy-washy back and forth. And then March and April are 2 of the best months of the year for value. So I think, we have sentiment has been absolutely devastated. We have positioning that there was more de-risking, according to Morgan Stanley, more de-risking over the last 2 weeks than in the 2 weeks that marked the March 2020 COVID low. And I'm sorry, I just don't see how this can be worse than a pandemic low. So to me, that's an overreaction. So Omicron fades, growth data picks up, Q4 earnings are coming in very strong. Q1 earnings are being revised up. Big tech is no longer the place to be. And we have an opportunity for running into the best time of the year for value. And so I think the surprise could well be that that the next couple months, the next quarter or so, is going to be really good and better than many people think. So in that sense, when we looked at our models, thinking about what did we want to do, one thing that was interesting is that I had a client call last week because when we update the models, we then have client engagement one-on-one with me as part of the service. And a client said, well, what are your 3 most high conviction ideas in the GMA, the Global Multi-Asset Model? And I took a look at my sheet and I said, it's funny, I can reel off 6. In other words, I like the portfolio, right? I like a lot of the stuff we have in the portfolio. So in the multi-asset portfolio, we did a little trimming, notwithstanding what I just said about value. We did trim some XLE. We took some profits. XLE was up about 24% in January. As you know, we've had a long-standing position there going back to late 2020. And so still have the bulk of the position, but took a little bit off the table and put some of that money into 2 different ETFs, one in the mining side. So kind of the iron ore copper type play as a play on this idea that growth is going to come back better than expected. And then also in the gold miners, where we think as it becomes clear that the Fed is not going to raise rates 5 or 6 times in 2022, more like 2 or 3 times, that gold and crypto could get a little bit of a bounce because they've been really negatively affected by the repricing of the number of Fed rate hikes. The other thing I think importantly to your audience might be that we added and initiated a position in EWZ in Brazil. And, basically we switched out of Canada, which we had gone into last October, actually at that time switching out of IOF, because we thought that Canada would be a better play on energy and financials. And surprisingly, Canada really hasn't performed very well. It kind of didn't do what it was supposed to do in the portfolio. So we exited there and added to EWZ, which seems to have kind of reattached itself to the commodity cycle. We think, as I mentioned earlier, close to the end of the tightening cycle, has stopped the domestic portfolio outflows, which really negatively affected the real last year. And I think people have taken on board the political environment. But more importantly for us is the idea that Brazil is back in line with the commodity cycle, which we think is going to continue to play out very, very well as the global economy recovers. And then the other things to keep in mind is, remember, we have our TPW20 thematic model portfolio, which has, frankly, struggled in November and December because every single ETF in it, all 20, are thematic and almost by definition high beta. And clearly, January was not a good month for high beta. But what we did was, in the view that I've expressed here today, we're putting our money where our mouth is. And so we took our cash down to 0 and added to several different thematics, including genomics, infrastructure, 5G, and the reopening trade with jets. So I was very happy to see today that there was a merger between 2 low-cost airlines in the U.S. and jets was up a nice 3%. I think that also tells us something, right? When we see corporate action like that moving at this point, it's telling you that folks in the boardroom don't think prices are going to get cheaper. They think prices for airlines are going to get more expensive. So they move now, as opposed to waiting until the reopening is fully engaged and people are traveling and the price of airline stocks are going to be much, much higher. I took a look from today. After the 3% move in jets, there's still a 30% move to get back to the high of last year, which itself was well below the high of pre-COVID. So it just, I mean, when you go and do the work and look at things, there's, it's just, there's so much stuff out there, which is why, as I said, the client said, give me your 3 top most conviction ideas. I said, I can give you 6 without even blinking. And that's a great place to be as a portfolio manager, as an advisor, to really have that kind of conviction. And it goes back to where we started, which is having the clarity. The clarity allows for the conviction. And then obviously you have to pay attention and take profits when it makes sense, as in XLE. But in general, we have pushed chips, onto the table in the thematic. I do think that strategic outlook is likely to transpire, which suggests the disruptive tech type space, the thematic space, this is a buying opportunity. And if I'm right about the tactical outlook, where lower than expected inflation, higher than expected growth, yield curve steepening, not inversion, and a potential for a spring rally, then there's not going to be a better time than where we are right now to make some of these moves. And so that's where we are.
Yeah, I fully subscribe to what you've said, and as we discussed, either last session or the session before, that the market had, we were at the maximum bearishness with respect to the Fed. So, as you said, you got all of that priced in. So, and it's clear by now that Omicron is fading, right? Because over the last 10 days or so, you got a ton of European countries reducing restrictions. So either Italy, Sweden, basically everywhere. So I mean, it is fading. So what do we have left? I mean, it looks like the big thing that could drive markets is a peaceful solution to this imbroglio in Ukraine. And it looks like the incentives are there on both sides, right? So, what you make of this, and also how would this affect, the commodity space? Because especially on the oil side, because if we see, some deflation in the oil price, I mean, how this would affect the trades?
Yeah, no, that's a great question. I mean, to be honest, we remember we did have Russia in the portfolio, in the global multi-asset model several months ago, and we sold it. And that turned out, in hindsight, to be a great decision, because we avoided all the sell-off in January because of all this uncertainty. I think there's definitely a couple of dollars in the oil price that can be attached to fears around the Ukraine and what might happen to Russian energy sources, both gas and oil, in the event of a actual shooting war. But I'd also make the point, that the Saudis have raised prices in pretty much around the world for their oil. So I think the oil issue is structurally a supply issue that is starting to sense that supply is not as prevalent as people would have thought. And when you look at OPEC plus over the last couple of months, they have not been able to meet the increased production that they signed up for. And that says that they're having trouble. So their ability to pump more oil is quite low, one would think. And now maybe there's talk now in the US of the shale patch getting going again, and rig counts starting to increase in the US. And some of that's probably likely to happen. But I do think we have a demonstrated limit on OPEC plus production, at the same time as we're about to see, I think, a global synchronized expansion and reopening, which could drive more energy usage, and therefore the price of oil continues to go higher. As I said, we trimmed XLE, but it was more to send a signal to our clients who follow our model that after a 25% move in January, on top of a very nice move in 2021 for XLE, you can take some money off the table. We did the same thing, you may remember, with KRBN, Carbon, a couple of months ago, the same thing.
It
We
was
still have,
clearly overbought. Yeah.
yeah, we still have the bulk of the position, but you want to just take some money off the table when you've had a big kind of windfall gain. And so I envision keeping XLE and AMLP, which we also hold, for the foreseeable future. But I'm of the view that there's probably not going to be a shooting war in the Ukraine. I certainly hope that is the case, and we'll pay attention to see how it all plays out. But even if there was if it became clear there was conflict, then the price of oil is going to go up, the price of gold is going to go up. Um, you know, treasuries may rally a little bit on a safe haven bid, but I would think it would be a couple of days because as all this time has transpired, backup plans, plan B, plan C, all that stuff has been kind of had time to develop, which is one of the reasons why I don't think there's going to be military conflict, because when there is military conflict, you kind of want to go suddenly before the enemy or the other side has time to prep itself. And clearly, there's been loads of prep time for the Ukrainians and NATO, et cetera, to address the threat. And so my hope is that this does not become an actual conflict, and there are ways, diplomatic ways, to kind of provide the comfort that the Russians are looking for in terms of their kind of security, and that the Ukrainians obviously are looking for in terms of their security. And that's for greater minds than mine, but that's kind of how I see it.
Yeah, I agree, and would you think that it's really a binary situation now, because a peaceful situation can really lead to reduction in oil price, gas prices, easing inflation in U.S. and Europe. But then if that doesn't happen, I mean, Russia can not only reduce, curtail oil and gas exports, but also there's a talk of them doing that in the fertilizer space, exactly when Europe is going into the planting season for wheat.
Well, I think, and I'm no expert, but I think they've already noted that they're going to reduce exports of some of the main inputs to fertilizer. So that's kind of already happened.
Yeah.
And again, prices have already adjusted. I don't think if there is a negotiated settlement or agreement of some kind, I don't think the oil price craters because, as I said, production, it's a supply issue, and supply is limited, and growth is going to be, I believe, in the next 3 to 6 months, going to be quite robust. So I don't see a big dramatic sell-off. I'd buy it certainly if there was one. But that's when we could go back in and take the money out of that we took out of XLE last week and put it back in there. So for me, that would be fine. But I don't see a huge sell-off because, as I say, I don't think Russia is the main driver to oil, Brent or WTI appreciation. It's a supply issue, and the market sniffing out that if we are at the end of Omicron and growth is going to start to pick up and people are going to go out and they're going to travel, then we need a higher oil price to clear the market. And that's what the Saudis are telling us when they, the low cost producer raises their prices. That's telling you that the market is tight, and that's how you get that kind of action. So I don't, to be honest, since we're out of RSX in Russia and we have trimmed our energy, and our European positions are in the banks primarily, as well as in value, broad European value. I don't spend a whole lot of time thinking about that particular issue. Right now, my focus is on this tactical, view on inflation and growth and yield curve inversion, and then searching out either pro or con arguments for the strategic view, which will drive, the thematic space in particular, I think. And in the interim, watching the action in some of the economic data to see, most importantly, the inflation and the growth numbers. That's really where I'm spending the bulk of my time.
Yeah, no, that's great, and it's been a great session. We talked about everything. There's just one question that I never give up on it, and maybe there's hope there. Is there any hope for Build Back Better, or is it dead? Can anything
Yeah.
replace it?
Yeah, well, again, for me, the focus there is on the climate side, right? The bulk of the climate adjustment money, 500 odd billion, was in the Build Back Better. And in the moment, that seems to be in limbo. Nobody really knows. Supposedly, Manchin, the senator from West Virginia, came out and said Build Back Better is dead. Maybe he meant that it was dead in the form that it was last existed or presented. Going forward, I do think that if the U.S. is not able to generate that the climate part anyway, then the likelihood of the U.S. meeting its Paris Accord targets becomes very low. And this is, remember when we talked about climate speed last summer, last fall, about how it telescopes time, right? That the Paris Accord numbers are 2030, 2040, 2050, and yet action in 2021, 22 is going to determine whether we get there. And so, that's really how I'm looking at it. And so, I think that the key is that 2022, as we've talked about, is the year of the electric vehicle. That's something that we see really happening. Electric vehicle sales doubled last year, year over year. They're expected to double again this year, year over year on a global basis. So that stuff is happening in the private sector. The government needs to support it with the money that was in the Build Back Better. So I still have some hope that something will come to provide a vehicle for that money to be allocated. The bigger rest of the Build Back Better seems to be, not feasible in the current political makeup of the United States.
Yeah, no, it makes great sense, and as we discussed, maybe someone else, replaces Senator Manchin or whatever. But we'll see how that happens. But as you said, for the portfolio, you basically got what's necessary for now. And 1 minute and a half left. Is there anything you think was left out, or let's say the closing message?
No, I think I just remind everyone of our model, our global multi-asset model, overweight equities with an overweight in cyclical and value within the U.S., geographically, globally underweight the U.S., overweight non-U.S. developed markets, Europe and Japan. Also very focused on China, continue to be very focused on China and believe in the risk reward setup there across equities, fixed income, and currency. Added now, initiated a position in Brazil. So that's our other emerging market allocation. Deeply underweight fixed income, as we talked about. Overweight commodities across the board. So from energy to metals and mining to ag. When you talked about fertilizer, we have a position in ag in the GMA. And then obviously the position there in, sorry, I'm just trying to remember a gold. Sorry, we added the gold miners as well. So, that's the commodity exposure. And then in thematics, as we talked about, the climate space with electric vehicles is a big focus. Uranium and KRBN continue to be a big focus. And then the disruptive tech and reopening plays with jets, also something we think really should be looked at. If you have a positive view over the next couple of years, you should really look into that disruptive tech space, because I think that's where the opportunities are going to be found.
That's great. Fantastic. Lots of great stuff. And want to thank you again. Want to thank you our clients, our audience, and we'll see you in exactly 2 weeks. If I'm not wrong, is the 21st, correct?
Yeah, days are flying by, Roberto. But
Yeah,
yes,
yeah,
2 weeks
already,
from
it's
2 weeks
almost the
from
end of the
today.
quarter. Yeah. I mean, 2 weeks from
Exactly.
today, it's gonna be, we're gonna be, 2/3 into the quarter. Yeah.
Yeah, well, exactly. And coming up on March and April, the two best months for value, for U.S. value. So hopefully people have made their trades between now and then. We should try to develop some sort of polling capability where we can get folks to tell us whether or not they're agreeing with us on the value call or the non-U.S. call. That could be fun. But until then, thank you for the time and great questions as always. And good luck out there for all the investor folks.
Thank you, Jay. Thanks again. See you in 2 weeks. Thanks, everyone.
Bye-bye.
Bye-bye.